Hey everybody, it's Pete. Good morning. Welcome to Stock Trading Pro. In today's Stock Market Live, we're going to answer the question is why is the stock market going down so hard? What can you do about it? What can you do about your positions that you already own? Are there some new positions that you could possibly buy? Are there some value plays right now that you should consider? And there's two big ones. One very, very popular company that are currently selling for what is known as under book value. We're going to take a look at those stocks as well. I'm also going to talk about two books, actually. Big thing this week with the Fed coming out. The stock market is going to react in an aggressive way to what the FOMC is going to do this week with interest rates. They are now pressured where for a while it looked like 50 basis points was kind of a lock. And I think I read last weekend that it's somewhere around 96% that they're going to raise interest rates. The Fed's going to raise interest rates by a half a basis points. Now, with the way the market is reacting to the last week's CPI number and inflation being higher, there's talk that they're going to be an even more aggressive Fed. So if you're wondering what stocks to buy right now, we're going to talk about that. If you're wondering how to make money on the way down, we're going to talk about that today. And we're actually going to do something together where we're going to run a scan together looking at some potential ideas, both on the buying side of things, some bullish ideas, and some bearish ideas. And we're going to also talk about why a lot of people are calling this the Big Short 2.0 somewhere, wherever Michael Burry is right now. I'm sure he's not happy the market's crashing, but I'm sure that his investors are very happy right now because he made another big bet on the market going down. And as of this moment, it looks like he's spot on again. We got a bunch of stuff we're going to talk about today, so stick around. We'll be back in 3 seconds. Okay, so thank you so much for being here with me today, everybody. I really appreciate it. I want to say hello to LJ. LJ, good morning, pal. How's it going? Thanks for being here with us today. I want to mention these two books first. I want to start out, obviously, the amount of stuff that's going on in the stock market right now and how stock prices and price action are just all over the place and in a good way if you're an aggressive, active trader right now. It's important to understand some of the economic factors that are affecting why the stock market is going up and down in such a strong way. We've been talking about it for a while now. You don't need to be a stock market genius. You just need to walk out of the house and realize that you're paying well over $5 per gallon for gas right now. Any place you go to the supermarket, everything is inflated in a much, much bigger way. So for those of you that don't understand what inflation means, it means the prices that we're paying are much higher than what they were even 3 months ago. So as a trader, I get a lot of questions about the bookshelf in the back. This is actually one book that is a pretty good one. You can see the author's name over here, The Trader's Guide to Economic Indicators. This will give you a really, really good breakdown of everything you probably hear on CNBC every day or Bloomberg, whatever channel you happen to watch. This is pretty good because a lot of traders react to what happens instead of kind of like what we call building the argument and reading the tape and putting those pieces together. This is a pretty good primer. But the big one I want to talk about is this book. And there's a really funny thing that happened when I just took this book off the shelf. Obviously, the FOMC this week, Wednesday at 2 p.m., the meeting starts earlier in the week. And then they make the announcement 2 p.m. Eastern time on Wednesday. There is going to be a lot of volatility this week. So really understanding that as inflation goes higher, the number one tool that the Fed has, the FOMC, to cool inflation, to bring those prices back down, is to raise interest rates. So I want to show you this book, and there's actually kind of something very funny. If that kind of stuff is complicated to you and you really don't understand, this book is very, very well written and will make you understand what's going on in a heartbeat. And it's this one here called The Lords of Easy Money. You can see the author here, Christopher Leonard. But what's super interesting for this particular moment right now, I like to put bookmarks and everything where it's important. And look at the look at the bookmark that I have in here right now for a Titanic exhibit. So I kind of think that that's a little bit apropos for the current market conditions. Very, very weird. So anyway, obviously they're going to raise interest rates coming up, and the market is taking a hit again right now. I want to start out with why the stock markets are falling. And actually, it was a really good article here in Barron's. Let me actually just bring this out a little bit. And it's all about two of the main things that we're talking about right now, the Fed and inflation. Those are really the two big things. Now, a lot of people are, like myself included, are looking at retail sales and what a lot of people will call consumer discretionary. So if we take a look at the sector rotation as we do every week, we break this down a little bit more, and consumer defensive is an area that we would expect buying pressure to come into the market. So now a lot of people are talking about how much things are going down, how scary it is right now. And look, let's face it, it is scary right now. If you did not trade through, never mind, didn't experience what happened in 2008. That was a unique situation with the credit default swaps and all those kind of things. We haven't seen something like this since the late 1970s in the stock market, maybe the early 1980s. So Reaganomics kicked in a little bit. We were coming out of a recession. A lot of people are calling it stagflation at that point, that's when you start to get unemployment numbers piling on to the other bad numbers already. What happened in 2008 was a little bit different, a little bit specific. But what I will tell you from a trader perspective, from an active stock trader perspective, it's absolutely amazing. I don't want to see anybody lose money. I don't want to necessarily see the market go down. But some of the most wealthy stock traders that I've ever been around made most of their money when the market was going down. And I tell this story all the time to everybody inside of our community. I remember very specifically, I was trading on 57th and Lexington in New York City. And there was this one guy, his name was Rich Fino. He made an absolute fortune every time the market rallied in a bear market, that he would short sell stocks and it would go down. It would go down. It would go down. He made millions and millions of dollars. And then in March of 2003, when the market finally bottomed out, they pulled down that statue of Saddam Hussein with the tank. He was shorted, doing the same exact thing in March of 2003, lost money in March of 2003, did the same thing in April of 2003, and the market started to go back up. He stood up in the office among 1,000 traders and said, "That's it, I quit, I'm taking my millions and I'm leaving," and he just left the market. Now, I don't recommend that happen. It was a super interesting thing to notice, but you don't have to go through the same thing if you understand order flow and tape reading. And I just want to make sure that you're on the right side of the market. Without getting into all the details and that kind of stuff, because we teach that in the boot camp, I don't want to kind of give away the secrets that we have in the boot camp. If you want to learn about the boot camp, you can click below the video and find out more about it. Our next one starts June 20th. But it really comes down to this. The easiest way to be in control of what's going on in the stock market for yourself is to track and piggyback what the smart money is already doing. So the number one way that we do that is sector rotation. So when we're looking at sector rotation, you can obviously, last week and on Friday, the market took a pretty big plunge, but you need to start looking at further and saying, within the carnage of the way the stock market's going down right now, where are pockets of opportunity? But I think even more importantly is, if inflation continues to be higher, if interest rates continue to go higher, which stocks will benefit from that and which stocks will be hurt the most because of that. We're actually going to talk a little bit about short selling stocks today. There's a big stigma about short selling, about there's unlimited risk on the short side, because if you sell a stock short here and it continues to go up, there's really no limit to how high it can go. And that's absolutely true. I want to be clear about that. Everything we're talking about here is for educational purposes. But let me ask you a question, and let's just hit the charts and let's keep things, amongst friends here. Let's go over to here to 2022 and talk about when the market started to reverse. The SPY was up at 480. Now it's actually 100 points lower from where it was. Sure, short selling might have theoretical unlimited risk, but how much risk are you willing to take as the market keeps going down every day? If you learned from what happened in 2008, and I hope that you do, because the stock market was a very, very scary place at that moment. When I had my trading floor in New York City, there were grown men and women crying because they didn't make a decision. They didn't have a plan for what happens if the market keeps going down. Now, one of the biggest things that scares me, it actually gives me the willies right now, is people telling me, well, the market always goes up in the long run, so I don't have to worry about anything. That's garbage. I have to be honest with you, it's garbage. I understand some people love companies and you want to stay with those companies for a long time. But what if we continue to go down for the remainder of 2022 and that stock that you love, the stock that you know, continues to plummet and you lose 3/4 of the value of your portfolio? Nobody wants that to happen. So you need to make decisions. At what point are you scaling back on those positions? And again, this is for educational purposes. I'm kind of giving you high level things to consider. You have to make the final decision on your own. And again, a lot of people are just starting to feel like we're going to start hitting the skids now, worse than where it was. And I want to give you some context for why everybody's saying that right now. So if we go out and we look to, this is where the pandemic started, right? That's the big crash that we had. And this is quantitative easing. So for those of you that don't know, right now, quantitative easing is what pushed the market up during this period of time, from here to here. Okay. We are now in a period of what's called quantitative tightening, which is the opposite effect of that. Money supply is changing, interest rates are going up, and that's going to hurt corporate profits. Think about yourself. Think about yourself, and you have your monthly income, whatever that happens to be, and all of a sudden your mortgage went through the roof. Like all of a sudden they could just change your mortgage rate. You don't, for whatever reason, like just picture that. So you're making the same amount of money, but now your net of what you have left over every month is going to be affected in a dramatic way. You're not going to have that extra money. Companies see that as earnings per share. Companies see that as dividends. So those numbers, return on invested capital, they're going to be hurt. So we need to pay attention as a group, as a community, to what are interest rates doing now? At what point do they start to change back in the other direction? And how does that affect which stocks we're going to be watching? But here's the thing that I want to point out. And I'm not saying this to scare you. I'm saying this to shake you, to make you think about making decisions. And maybe you're going to be buying puts. Maybe you're going to be hedging with futures if the market continues to go down. That's going to protect your portfolio of stocks that you own in the long run. But here's the thing I want to point out. This is where quantitative easing started. This is where we were prior to the pandemic. So a lot of people are looking at this number because this is where everything crashed and we got right back to that level now. Look at where we are now at 389, 380, 339 is just getting back to that level. That's some pretty big room to the downside. So what I want to do is I want to ask you to level up. I want to ask you to say, what do I plan to do before you need to do it? Now, a lot of the members of our community, we pull out ideas on both the long and the short side of the market. So that's one way of making opportunity in what could potentially be the next big short right now. So that means you're looking for strong stocks to buy, which again, we've been giving you these for a while now, is energy stocks. And as long as the energy supply continues to be what it is and futures are actually continuing to go through the roof, we're going to continue to look at energy stocks. So some of those ideas, obviously we take a look on the weekly charts. VLO has been just an amazing, amazing stock. And there's a whole group of stocks that would meet that criteria. So what I want to do is we're going to do a little bit of a search in here. We're going to go into VLO. And one of the most important things you could do is look at both the broader sector as well as the individual group, because we already know this stock is exhibiting strength, right? So we're going to break it down and go into energy. And then we're actually going to go to average volume of at least 1 million per day. Average true range of at least $1.50. So that's the minimum criteria that I look at. So again, this is one of the things. We actually got somebody in our Facebook group the other day asking me about a $3 stock that trades, I think, like 50,000 shares per day because there was some news story out there and they wanted to trade that penny stock. I want to give you, again, super high level lesson. I don't want to call it a tip because, again, I'm not your financial advisor, but a super high level lesson is that you want to trade stocks that have institutional attention on a consistent basis. So here's the thing I used to say was when I was on my trading floor. If nobody else is trading that stock, why are you? We make money when the smart money pushes stocks up and when they start dumping supply. We're following what they're doing. So if a stock has their attention, generally speaking, that will at least put it in my universe. So smart money attention plus consistent volatility. I have liquidity to manage the trade. And I also have volatility, which is an opportunity to make money. So when we run these scans and we start looking for what's going on here, over 1 million is a minimum. I generally go to 2 million and over $1.50. You can see 40 stocks meet that criteria in the energy sector. But we want to break that down even a little bit deeper. We want to start to go into above the 50-period moving average. And again, if you are a regular viewer of the channel, which I really hope you are, because we get some really nice feedback. And if I'm providing value for you, if you could do me a favor, just hit that subscribe button if I'm helping you. So that's generally where we stop. We generally look at that and we come up with some numbers of stocks that are showing some relative strength. And you can see some on the screen here that have now pulled back into what we might call a bull flag. So if we look at APA or AR, even VLO on the weekly chart, but if we look at this now, that's a really clean bull flag. So again, if you remember what we talk about all the time, we manage risk during the pause and we make money during the push. So last week, especially Wednesday, Thursday, and Friday, a lot of the energy stocks pulled back, but they still have strong bullish order flow. So now we're technically looking at a pause, looking for the next entry. So if we take a look at some of those stocks, VLO, APA, AR, they are still in big, longer-term bullish order flow. So if we continue to work our way through what we just talked about, that is only the technical perspective, but we want to add a little bit more juice to that. Which companies are actually still producing year over year good earnings per share? So the technical adding a little bit of extra juice. And we're just going to go year over year because quarter by quarter is a little bit strange right now with the way the interest rates are going right now. So we're going to go year over year. I'm going to add that into the equation. Earnings per share growth year over year. So we got this year, next year. Okay, so what we're going to do is we're going to go this year, and we want to see a minimum of 25%. And that only knocked out two of them. So what does that tell you? That this entire group of stocks, which is, again, when a lot of money is flowing into one particular group and their earnings per share is growing by 25% this year, those are the ideas that have that extra smart money attention because we're buying for the future cash flows. So that's one area. The next one we're going to look at is an area that's been beat up, actually, which is consumer staples. I'm actually going to remove this. And in this particular software, it's called consumer defensive, if I'm not mistaken. And now we're going to look at that. So only 7 stocks meet this criteria in consumer defensive. So if you don't know what consumer defensive is, sometimes it's known as consumer defensive. Sometimes it's known as consumer staples. Basically the same thing. It's like Walmart, J&J, those kind of things where they are stuff that we need no matter what. Consumer cyclical is stuff like Tesla and electric vehicle stocks and high-end electronics. Those are things that we would get when our discretionary money goes further. But as inflation goes higher, and again, you definitely want to grab this book. It's a pretty good one. I don't get anything. I'm just passing along a really valuable asset, I guess you would say. And I do think it's kind of funny that I have a Titanic book holder in there right now. So we're kind of thinking about consumer discretionary on the other side. We're going to take a look at that in a minute. But consumer defensive are stocks that we would expect to hold up regardless of the market because we need that no matter what. We need gas, right? We need that right now. We need Band-Aids. We need powder. Like we need that kind of stuff, right? So if we break that down and we start to take a look at the same thing over the 50-period moving average and consumer defensive, you can see that we have a list here. Dollar General is one. Kellogg's is one. That should not surprise anybody. And Philip Morris. Now, Philip Morris is an interesting one because we've actually been taking a look at this one where this is really kind of an advanced thing. And I want to just point this out. We just briefly mentioned what a bull flag looks like. So you got bullish order flow, you pull back, and it's kind of classic trading strategy. Anybody involved in the stock market, when a stock goes up, makes a new high, it's kind of, you have to buy that pullback expecting it to retest the high. If it's the first pullback or every time prior to that it made a new high, you should be looking to buy that because you have to prove that the buying pressure is still there by taking that trade, right? This one's a little bit different. PM is still in longer term bullish order flow. But what's interesting is you can see here, it rallied and paused, rallied and paused. So this pullback is technically still looking to make new highs, what it did. And then we pulled back here and made new highs again. Now, what's interesting about this one is it pulled back, rallied, made a failed test of the high, but we traded into what we call a bullish U-turn. So if you remember when we talk about bullish U-turns, let me see if I can give you the exact language on that. I just want to make sure that I walk everybody through here. So this is what a bullish U-turn looks like. And I just want to pull this in here. You might want to, there's certain things I give you. Make sure you take a screenshot of this because this one's kind of important because there's 2 elements to why I'm looking at Philip Morris reversing for this week, for this coming week, despite what's going on with the Fed. So bullish U-turn occurs after successive candles to the downside. The current candle trades below the previous candle and U-turns, right? We have short-term momentum, and then this candle trades below the previous candle. You can see the fancy tool here. But here's the thing. The current candle must close above the opening price and close above the previous low. So bullish U-turn is short-term momentum is going down, then one candle reverses back in the other direction. So if you can think about it, those that were short selling that recent price action are now caught on the wrong side of the trade because it actually did continue to go down, but reversed. But I want to be very clear about this. A bullish U-turn is a momentum reversal, not an order flow reversal. So that means that bullish U-turns are entries or exit signals. So if I was a buyer and we're going to the upside and we got well bid, we got green, higher highs, higher lows, and a bearish U-turn happens, I would move up my trailing stop loss. If I'm looking to be a buyer of a stock where I have long-term bullish order flow, we've pulled back for a couple of days, and then I get a bullish U-turn. In this case, that bullish U-turn is going to be an entry setup for me. But we could make it even better. And we're going to go back over to the Philip Morris chart. So if we head on over to the Philip Morris chart, you can see that that's a bullish U-turn. You can see that it's almost identical where we have candles to the downside. This candle reverses and trades back to the upside, right? Almost perfect to what we're looking at right there. But it gets even better because this is where you got to put the tape reading aspect of it into. The volume was actually still pretty good on this candle as well. So all of these things combined, regardless of where it is right now, I am looking to be a buyer of Philip Morris this week. I want to be clear about that. I'm looking for a short-term swing trade in that stock this week. Everything pretty much in the market is actually taking a hit right now, but because of the other factors that we just talked about, consumer defensive, the bullish U-turn, and strong bullish order flow over the last, let's say, 3 months, right? We're basically talking about going back from March. This long-term trend is still valid. Again, if we're drawing the boxes here, this would be the level that we'd have as a stop. Still valid, still looking for those stocks to be in play, and that's what consumer defensive is. If we go over to healthcare and do the same exact type of a search, and again, Dollar General is another one just to give you some ideas heading into this week. Dollar General, nice bullish gap here and continuing to follow through. We want to now go over to healthcare and take a look and see if any healthcare stocks meet the criteria. And there actually are a couple of them. Okay, PCAR, PWR, and CMI. Now, remember, we're looking at the most minimum price action right here. If we want to break this down even a little bit further, we could break it down by performance for the last month. But this is the list of stocks that I'm looking at right now. But what I want to walk you through are ideas on the other side of the tape. So right now we know that technology stocks are growth stocks. So most technology stocks are known as growth stocks, right? And they borrow money, generally speaking, to fuel that growth so that the future cash flows will pay down that debt. Well, think about what we're talking about now with the Fed. The Fed this week is supposed to aggressively raise interest rates. So which companies are going to be affected the most negatively as interest rates continue to go up for 2022? So we're talking about making money for the remainder of 2022 if the stock market happens to be the big short and we hit the skids and continue to go down towards that 339 level that we just pointed out. And that's not to say that we can't go down further, but we need to know where we were prior to quantitative easing starting, which again, if we go out to the weekly charts, that's basically what we're looking at over here. That's kind of the level right prior to that. So if that happens and we start looking at the other side of the market and we start to go into tech and we start to look at tech on the other side, which is below the 50-period moving average, look at the amount of stocks that meet that criteria. That is a gigantic list of stocks. So we want to keep working that down even further. So the 50-period moving average is one thing, but now we actually want to work our way down even below that, below the 200-period moving average. Because remember, what we're doing right now, we're not looking at trades yet. We're looking at stocks that meet the criteria. Then we go to the individual charts and we determine whether or not they are valid short sells right now. Now, the way that you determine that is you need to know the average true move for that stock. Now, this is a big challenge for a lot of people. And when people come into our boot camp, it's the number one problem where they can identify that they want to be a buyer or a seller of a stock, but they're not buying at the right time. And that's a big thing. There's two ways to make money in the market. One of them requires a lot of patience, and the other one requires just a little bit of skill. Believe it or not, the one that requires the most patience is where you make the most money. So we have a saying that is time in the trade or timing the trade. Now, everybody is all obsessed I need the exact entry. Give me the exact spot. And it's important. But we have 256 people on the call with us right now. And by the way, thank you. I'm so grateful for that. We can have 256 traders buy the stock at exactly the same price, and we can end up having 256 different exits. So if that's the case, that really means that the money to be made in the stock market is time in the trade, what happens between entry and exit, not so much the perfect entry. You still need to know what a good entry looks like, but how long you stay in the trade is what matters. Just want to throw that out there because it's a really advanced lesson. So if we continue to work our way over into this list, and I'm just going to zoom this out. And I think it's interesting that Apple's actually at the top of the list. We're going to break this down even further, 10% below the 200 period moving average, which means that these stocks are pretty weak. So again, look at how much we're breaking this down. We want to filter this down even more. We're going to go to overview, and we're going to sort by industry. So we got sector and industry. So our goal right now is to pay attention and see if we sort this. Let me actually bring this over to performance, and we sort this by performance down for the last month, and the bigger ones obviously at the top of the list that are the weakest for the month. And then we go back into overview. We should now be able to see the pockets of opportunity in software application. So now we're going to break that down even more, and we're going to go right over to software application right there, because this is the bigger list of stocks. And now we just broke that down to 40. So what I'm going to do now is I'm actually going to give you this list of stocks. You might have to click on it one more time to open it up, but I want to give you this list of stocks because we're going to talk about short selling now. Okay. So there's the list of technology stocks. If you click on that, if you don't happen to have a subscription to FinViz, don't worry about it. You click on it. It'll bring you up the list for you. You don't need a subscription for it. So now what you'll be looking for are stocks that are at or close to the optimal entry. So if you don't happen to understand or know what it means to short sell stocks, short selling stocks means that you are betting the same. If you know options trading, when you buy a put, you're buying a put expecting it to go down. Okay. Short selling is the same exact thing, except you're actually selling the stock expecting it to go down. Now, a big challenge that a lot of people have right now mentally, and I know I did when I first started trading as well, is I don't understand, how do I sell something that I don't own in order to short sell that stock to profit if it goes down? So the way it works is, let's suppose that you go to your broker dealer and you say, I want to short sell Apple. So what actually happens is you borrow those shares from your broker dealer and you sell them. And then at some point in the future, if it goes down or up, either way, at some point in the future, you have to buy those stocks back and put them back in the inventory for your broker dealer. So that's how short selling works. You're borrowing this stock from your broker dealer to sell it, hoping it goes down, anticipating it goes down. If you do, now this is important, you have to buy that stock back. When you buy that stock back, the trading language means that you covered that stock. So this is kind of cool because we're going to kind of bring this all the way back. I'm sure you've heard of a short covering rally. Well, what we just talked about is short covering, meaning you shorted it, you covered it to get out of it. Now, a short covering rally means a whole bunch of people think that it stopped going down and they covered quickly, and that was a short covering rally. So what we just gave you, that list that we just gave you now, is to determine which of those ideas are close to the optimal entry to look for a new short sale. Now, I want to say this, and I want to say this as your friend because it's very important. Short selling does have this, it does have risk. The same thing as if you were buying stock, because again, a lot of people are under the water right now on stocks that they've owned for a long time and the market pulled back. It's critically important that you understand how to exit a short sale and put those stops in as soon as you put that trade on, because any news could come out and that thing could go flying in the other direction. So be smart when you understand short selling. But what we want to do with this particular list here, which is we're breaking it down on technology stocks and looking at stocks on the short side. We're actually now, and this specific group, we're going to now go into the charts and try and determine which of these stocks are worthy of short selling. Now, I generally don't short sell anything under $20. Generally speaking, I would like a price over 40 even, and that's probably going to cut off, that just cut off 17 stocks. So now what's interesting here about Zen, let's actually pull that up on the daily chart and break that down and go over here. what we are looking at in Zen now is Zen has actually fallen 7 days in a row, including this big gap to the downside, and it's moving further right now. So what you need to start doing is paying attention to what the stock normally does when it normally moves. So some of these ideas that we're about to look at have gone too far to justify a new swing trade short sale. Because remember, the only reason we choose to accept risk is because the likelihood of earning acceptable profits is pretty good. But if a stock has already gone what it normally does or more, if we put a trade on at that moment, it's not worth it because the risk to the reward is basically break even at best. So if we have to risk $1 and the likelihood is we'll make $1 because it's already gone too far, that's not a good trade. Those are the trades that we want to avoid. So in the case here of Zen on a short sale, it's gone pretty far. So could it go down a little bit more? Sure. But how much risk would you need to take to justify expecting it to follow through? That's a little bit different in this guy right now on the other side because it's already got bullish order flow and pulled back, and it looks like it's going to open a little bit lower. So I just want to say what I'm looking to do in these stocks this week, the energy stocks specifically, because they have longer-term bullish order flow and they're set to open this morning, I am looking to buy those energy stocks on a pullback this morning if they bottom out and show me some short-term price action to the upside. So I'm looking to buy energy stocks on the push lower this week, not necessarily just for today, for this week. And I'm looking to short sell technology stocks that are not too far from the optimal entry. So let's take a look and see if we can find a couple of those that would be. So Zen is actually too far. If we take a look at WDAY, let's see if that is still within a reasonable area. It's okay. It just broke down here. It's still $149 and change. So this one does still have some room to go. Let's see if we could actually find something that is a little bit of a better idea. So Snow has been one that we've been watching pretty much every day. And Snow actually is right near the optimal entry. So again, this is what Snow normally does. You can see it just broke out of this consolidation after being sideways for 2 weeks. And it went down from 181 down to one. So that's almost a $60 move. Let's just say 55 for the sake of this argument. Now, this is the first day that Snow broke down, same as this. So if you take the first day it breaking down and let's just say 164 down to 128, just for argument's sake, that's still a pretty decent move. So Snow, for what you have to risk, still has some room to go. So these are the things that we need to actually consider before we hit that buy button, before we hit the sell short button, is what is the likelihood of more profit being available? If it comes back that, well, it's gone quite a bit already recently, I'll probably stay away from those trades. And that's how you learn to mitigate risk, by staying away from trades that don't have a high probability of following through more for the risk you have to take. Snow is a little bit expensive. Maybe 115 might be a little expensive for some people, but you do want some room to go. So now we already know that it has room to go. We already know that it has bearish selling pressure, and we already know that it's in one of the weaker sectors. And we broke that down even further. That Snow is also in one of the weakest industry groups. So again, I just want to point that out where I'm getting industry group from and sector. So what we did is we broke that down. If we go over here to overview, technology was the sector we were watching. Then we broke it down a little bit further to the industry group that was showing the most weak stocks over the last, I believe it was over the last month. And then we broke that down even further to these stocks. And now we're taking a look at which ones are the best idea to short sell now. So I want to give you kind of like a glimpse behind the curtain of some of the ideas that I'm looking at today that are in my personal trading plan. Now, Snow is actually down $6.82 this morning. And that's a pretty big move for what the stock normally does. Now, let's take a look at what the stock normally does and where it's set to open right now. So if we head on over into Snow and we click on that, we're going to get what the stock normally does per day. So $12.55 is the average true range. So you can actually zoom that in and maybe see that a little bit better. $12.55. So what that means is that on a intraday basis, from the low to the high, Snow normally moves $12.55. Now, already this morning, pre-market, it's already moved $7. So $7 out of what it normally moves in one day, $12.55. It's already gone more than 50% of what it normally does. So if I'm looking to trade snow today and short sell it, I'd be a little bit more inclined to be shorting the first rally, expecting that to go back down, as opposed to shorting it as soon as it opens. So these are kind of fun things to talk about, because now we're talking about not only which ideas to consider, but then we take it a step further to how do we plan to trade those ideas. Now, obviously, this is just one idea we're talking about right now. I do this all day, every day, where I'm giving you the ideas, I'm giving you the stocks, I'm giving you the entries, the exits, all that kind of stuff. But I think it's kind of fun to maybe help you level up a little bit, to know that there's a lot more to add to the puzzle. It's not complicated. You just need to have the list. Once you have the list to add to the puzzle of order flow, tape reading, optimal entry, and what does it normally do, then it's really just a question of having the right stocks in your list. Obviously, we could talk about this all day until noon. I actually have to get ready for the game plan call that starts at 8:30 with our bootcamp members and members of our Order Flow Pro. Click that link that I put into the chat. Look at that list of stocks and see if there's some ideas on the short side of the market that meet your resources that you would consider. If you do, remember, put that stop in first. Put your trade on, put your stop loss in, so you're always managing the risk, which is what professional traders do first. The other side of the market, we're going to start looking at some consumer staple stocks, also known as consumer defensive. I'm looking to buy Walmart, Costco, Procter & Gamble, Philip Morris this week, Dollar General. Some of them got beat up recently, but they're showing signs of buying pressure after they took a big hit. And obviously at the top of that list is energy stocks. So if you have any questions about anything we discussed today, absolutely leave a comment below the video. If we helped you today, definitely give me a thumbs up. I'd really appreciate it. If I provided some value, give me a thumbs up. And I'm going to post another video on sector rotation at the end of this. You can click that video and watch it as well. Have an awesome day, everybody. Thank you so much for joining me. I really love these stock market lives, and I hope you do too. I'll speak to you soon. Have an awesome week. FOMC coming out on Wednesday. Be prepared for that. Have a great day, everyone. I really appreciate it.